What's up, everyone? Welcome to More Than Mortgage. Chad Anderson, Zach Jones, 24th episode today. And we wanted to dive into an acronym that a lot of people freak out about, taboo. You don't bring it up at the dinner table. It almost goes in there with politics and religion.
Yeah.
PMI, everybody's favorite word. I think maybe the only other truly dreaded mortgage term than PMI. Obviously more than but nothing trumps foreclosure or bankruptcy. But how about arm loans, adjustable rate mortgages? Maybe that's the only other acronym that is, quote, scarier in people's perception than PMI. So Zach and I are going to talk about that today. And we're probably going to blow your mind a little bit, to be honest, because we're going to have, I guarantee you, different takes than what some of you watching will either believe or will have thought at some point in your life. We got some stories to tell, good and bad on this stuff. So we're going to dive into that. But first, Zach, how are you, man? Good to see you.
I'm good. I'm glad to be here. It's a good day to talk about PMI and maybe dispel some myths, maybe offer a different angle on things. And what you're going to get from us is math. You're just going to get math. It's going to be rational math. So that's a good place to start.
Here's the great thing that I love when it comes to mortgages. Okay. Realtors obviously deal with math because you're doing, contracts and negotiations and, closing costs, and you're trying to figure it all out and who's going to pay for what and what's going to be financed and just all these different things. Like math is involved, but there's a lot more just negotiation back and forth. What we do is just math. Literally, it's just math because it's which option's better. Well, here's the math on it. The only variables that come into play are things like how long do you anticipate living in the home?
Right.
Or, and is it worth it to pay certain things? Or is it worth it to buy discount points? Or is it worth it to put more money down or not, or hold on to your cash? Like, you don't know the real answer. I always kind of make the joke, like, we won't know the right answer until 2, 3, 5 years from now. Because
Right.
it's literally a look back. That's the only way you know if you made the right decision is to look back at it, which is a horrible way to live, by the way, to constantly be looking backwards. So let's first what is PMI? Okay. This is the most simple way I can explain this. PMI, the banks are literally just saying, we're going to take on 95% or 96.5% or 97% or even 100% of the risk in allowing you to become a homeowner. Meaning you can buy a home with 0 down, 3% down, 3.5% down, 5% down. And we're basically, we being the bank, saying, look, we'll take on all the risk. But to help us alleviate some projected defaults that are inevitably going to happen, we're going to charge you a mortgage insurance premium or private mortgage insurance. That money is then going to be held, collectively set aside. And basically, if you're a good paying customer, you're subsidizing the defaults of others. So that when somebody does default, money's in the kitty so that the bank can go and pay for that deficiency or whatever the lack thereof on settling up that note and when they have to go through the foreclosure process and so forth. So anything I missed there, Zach? Like, that's kind of the baseline for PMI. That's what it is.
Yeah, a lot of years ago, you had to have a minimum down payment, and I think that everything started about 20%. And in an effort to increase the rate of homeownership in the United States, PMI emerged, and this was not a lender. This is not a lender product. This is an independent mortgage. It's an insurance product, and so basically, it allows people who have less than 20% down. It gets a little bit more expensive as you put less down. It offsets the risk to the lender and allows people to buy homes with less than 20% down.
Yeah. But think about that. Like, go back to that. You probably didn't, if you're watching, didn't lock in on something because I said it kind of casually at the beginning there. The bank is literally letting you take on a risk for the largest asset of your entire life, and they're only requiring you to put 3 to 5% into the deal.
Right.
Like, where can you go and get to control 100% of the asset for only a 3 to 5% deposit into the asset.
Nowhere but real estate.
Real estate. That's it. That's
Yep.
it. And okay, say what's the worst that happens? You can't make the payment. They foreclose on you. You have a deficiency. You get a judgment. You go bankrupt. 4 years later, you get to do it again.
Right.
It's crazy, right? Like literally, you can just do it, roll the dice. Worst case, you forfeit it all back. And really, with FHA, 3 years, 4 years later, conventional 7 on a foreclose. But you get to do it again. You literally get to do it again. And there's ways to manipulate that timeline based on bankruptcy. So anyway, this leads us down the path. I'll let Zach do his opening argument here, but this leads us down the path to, hey, look, PMI should be your best friend in the whole world. Literally, it should be something you crave, something that you want to be friends with PMI, because PMI is what allows you to buy a home without having to wait and wait and wait and wait and save until you get that 20% down mark.
So you're really likely to get the boogeyman lecture from your dad,
or other influencers.
Dave Ramsey, who is everyone's dad when it comes to money matters.
Yep.
PMI is evil. Mortgage insurance, you never want to pay it. It's too expensive. This is absurd. You need to have a bigger down payment. And that's a very simplistic view. And maybe in certain periods of time, there was a real strong aversion to PMI because it was extraordinarily expensive because there were lots of foreclosures. Now, remember, this is an insurance product. So remember when car insurance was really cheap, everybody's wearing their seat belts, the safety standards were really high, and we had no cell phones?
Yep.
That was the way insurance companies got you in to insure your house and everything else, was these cheap automobile rates. Now, automobile rates due in probably singly to the cell phone are extraordinarily high. We've got more safe vehicles than we've ever had before, but we also have more distracted drivers. So in our current situation, let's kind of compare 2010 to 2024. 2010, in the middle of the mortgage meltdown, lots of adjustable rate mortgages, the economy is collapsing, foreclosures are through the roof. That means that the insurance that insures lenders in losses about foreclosure is very expensive because they're paying out lots of claims all the time. Fast forward to 2024, our foreclosure rates are the lowest in history. So PMI, mortgage insurance premiums, are at the cheapest level that they've been, that I can ever remember them being. I've been in the business 20 years. So the evil PMI lecture that you get from influencers or from, old timers, boomers, if you want to be derogatory about that, my generation. I'm just barely a boomer. I'm really kind of late Gen X, but
okay, boomer.
late boomer, late bloomer.
Yeah.
Both of those are true in my case. So the changes that we see now really don't apply. And there's also multiple types of mortgage insurance for different loan types. And then mortgage insurance that can be kind of carved up into different buckets, depending on the market that we're in, that eases the sting of what that is. And then, I mean, I think that the icing on the cake at the end of our discussion is talk about mortgage insurance at retail lenders and banks versus brokers. That's another topic of conversation.
Yeah. So here's the thing. This is something I go over with people all the time. It really is my gotcha moment a lot of times with customers when they're talking about, PMI and 20% down and all this stuff. First off, keep in mind, Zach and I don't get impacted either way. Like, you do a loan with us, you put 20% down, you put 5% down. Technically, we make a little bit more money if you put 5% down, because I'm just doing this for transparency, because the loan amount's higher. We get paid by the loan size, not the purchase price. So at 5% down, technically you're making you know, 15% higher on the loan size. But think of it this way: if you got a $400,000 loan, 5% down, it's 20 grand, 380, you know, is the loan size. 20% down, 80,000, 320 is the loan size. If you make a point, then Zach gets paid 3,200 versus 3,800. I can promise you this: neither one of us are sitting here worried about, oh my gosh, I'm gonna try to talk my customer into something else just because it benefits me by a few $100s. That not how we live, not how we work, and so forth. So I want to do a quick math explanation for you. And so we're going to bring up the calculator here. This is what I'm going to use 400,000 as the number. Now we're not going to use sine, cosine, and tangent over here, but we're going to stick to the simple stuff today. So if you've got a $400,000 home, okay, then that's 80,000 is 20% down, right? 80 grand. Well, 5% down, it's 20 grand. Very simple. You have $60,000 left over if you only put 5% down. But then somebody says, wait, the PMI though, I got to pay PMI if I don't put 80,000 down. It's actually baffling. I guess it shouldn't be, but it is. How many people don't realize how cheap PMI is? Like, I think some people are programmed that if you said, well, how much do you really think it costs? And they say, I kind of want to do this. Maybe I will on the next customer.
Yeah.
Who says, I don't know if they're thinking 500 a month. I don't know. But I know this, in that you can get PMI with 5% down, depending on if you qualify. This isn't an offer to lend, all the disclaimers, etc. Don't throw me in a Facebook real estate group and talk about how I'm over here advertising crap. That ain't it. So if you took 320, or I'm sorry, 380, that would be the number, because that's 95% of 400. Okay. Take 380. Well, there are times we can get PMI, both of us, as low as a 0.19 factor. Okay. Excellent credit, the whole nine. 722 is the yearly PMI. So you divide that by 12. Look at what you're paying for PMI per month.
$60.
$60. Okay. $60. $60. And the difference is you put 60 grand back in your bank account. Now, everybody will say, well, yeah, but your mortgage payment's higher and you're paying more interest. That's true, but we're compartmentalizing here. We're talking about the decision of paying PMI. So if the penalty for not putting 20% down is $60 a month, right? So let's take that back out and go to the annual number of 722, because we'll reverse engineer this. And this is what I show customers. $722 a year, Zach. What do you get back? You get back 60,000. So if you divide this by 60,000, which is what you keep, that's 1.2% annually. You pay 1.2% to keep $60,000 in your bank.
Crazy.
So my question to you then is, I love customers because I kind of just lead them down the path here. So when we get to this point, I say, hey guys, where can you go borrow $60,000 from anywhere at 1.2%? You can't. You literally can't. You cannot borrow $60,000 for 1.2% annually. And when you break that down, it really opens a lot of eyes. Like, if you took the 60 and just invested it in a market account that returned 5% the way rates are right now, you're blowing PMI out of the water. It's not even close.
Right.
So that's just my favorite example, because like we always say, math doesn't lie. I mean, the numbers are right there. That's my favorite example because it's black and white. You can't argue that. So I don't know I want to hear how you kind of talk to customers through PMI, because that's always my spiel.
No, that's a great way to talk to customers about that have money and they're trying to make a choice about how much they put down. And then you can kind of dig in a little bit about the difference in the monthly payment by not putting that extra $60,000 down, et cetera. But I'm going to go all the way over to the other side, and I'm going to go to the Dave Ramsey argument that if you don't have 20% down, you shouldn't buy a house.
Yeah.
So let's say that you got that 5% down, you got that $20,000, but
Here, you want me to bring the calculator back up?
I mean, you can do it if you want to. My math is real simple on this.
Okay.
If you don't buy that $400,000 house this year because you don't have a $20,000 or you don't have a 20% down payment, all you've got is the 5%. That $400,000 house, the new numbers just came out. Case-Shiller Index says 6.1% appreciation across the United States year over year, from May to or April to April of last year to this year, 6.1%. So if you bought that $400,000 house is going to be worth $424,000 next year. So for the price of paying mortgage insurance at $720 a year, you get to enjoy the appreciation of $24,000 plus that doesn't even take into consideration the amortization savings and the savings in rent. So being able to get in, I mean, over and over again, Chad, it keeps coming back to where real estate is concerned. If you're moving up in value in real estate, you need to do that sooner, because time is going to work to your advantage, where the market, even this depressed, kind of lackluster market that we've got going on, is clipping along at 4.5 to 6%. And that you cannot beat that in time, especially when you're talking about a small down payment and the 6% return on the larger money that you're borrowing. Right. So those are kind of my arguments about mortgage insurance. Again, it's very cheap, relatively speaking. And even if you don't have great credit, you're going to be in a situation where mortgage insurance is cheaper than it's been before with an FHA loan. So let's talk about a little bit about the structure. We've been talking about a conventional loan where you got 3.5%, 5%, 10%, 15%. You're all going to have mortgage insurance on those. It's going to decrease in the premium amount as you increase your down payment down to 80%, and then it vanishes. The FHA loan program, which is a little bit friendlier if your credit scores are a little bit depressed, starts at 3.5%. But the mortgage insurance is all the same. There's an upfront mortgage insurance premium that's typically financed into the loan. And then Chad just gave you an example of a 0.19% mortgage insurance premium on a conventional loan with excellent credit.
Yep.
FHA is going to be 0.55. So it's a good bit more, but it doesn't vary if you get down into those, 680, 660, 640, 690 scores.
580.
580, down to 580. It's not going to vary. And it kicks down to 0.50 if you put a larger down payment down. So the downside is that FHA mortgage insurance is not going to fall off unless you put a larger down payment on this. It's going to be on for 11 years. Nobody stays in their loan for 11 years. So you kind of think about FHA mortgage insurance as a permanent type of mortgage insurance. And then you got VA has no mortgage insurance, has a funding fee on the front that's financed into the loan, but there's no monthly mortgage insurance on VA. So it's not really a factor in the way that we talk about PMI. And
of course, you're exempt if you have any disability with VA. So veterans usually know that, but bring that up as well. On FHA, here's the other thing that's great about FHA, why I love FHA. A lot of times people get nervous or afraid of FHA. They look at it, we went through this when the market was stupid hot 2, 3, 4 years ago, where people didn't want to take FHA offers because they look at it as more paperwork, more scrutiny, all these things, lower qualified
buyer. Scared of the acronym? Are we scared of the acronym again?
Right. Yeah. I mean, it's just all this stuff. But here's the other good thing about, or why I love FHA too, is because you could take like first-time home buyers, especially, and they can get into FHA easier a lot of times than a conventional product. And sometimes they haven't had the chance to build their credit. It's not that they have bad credit. They just have limited credit. So your score, remember, when you start establishing credit, you don't start at 800 and then work backwards. They start you in the middle. They start you in that 640 to 680 range. And then you just kind of go from there and you can build it up quickly. But we'll do another episode on credit one day. But on the FHA piece, what's great is you buy that asset, right? And here's the other thing, you mentioned it. Even if you have PMI, houses are appreciating 6% year over year. I mean, they went nuts and they're still appreciating even with high rates.
Right.
You're not going to have the loan for more than a couple of years. You're going to refinance. You're just going to, and you're going to get rid of the PMI. Or in an FHA scenario, you refinance to a conventional loan and reduce your PMI. And so you go from the 0.55 factor down to 0.19 or 0.25 or whatever it is. So you save on the rate and you save on the PMI. So there are other things. It's not like once you have PMI, it's not some terminal illness. I mean, it's a best friend who lets you get into the house for cheap. And now you don't need them anymore, and they're okay with you dumping them, and you run off and get you another loan. You don't have PMI the second time around.
Right.
That's a possibility. Also, the PMI could just simply get cheaper.
Mm-hmm.
You buy a home at 95% loan to value, refinance it, and it's 85%. Well, guess what? The PMI is cheaper at 85. Easy enough. But again, PMI should be your best friend because it allows you to secure an asset that has historically in this country gone up, 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 up. Of course, we've had our windows of time that were bad. Everything does. But over the period of the history of this country, real estate always appreciates over time. So PMI should be your best friend. Zach, you want to finish off on, PMI may not always be as it seems, depending on which lenders you're talking with.
Yeah, so this is kind of an interesting topic because it's I talk about peeking behind the curtain a lot because we're always life is kind of one constant discovery of things that we thought were one way and then they weren't exactly that way and they're actually a different way. PMI is one of those ideas, and you could talk to a dozen lenders who've been in the business a decade, and most of them, 8 out of 10, 9 out of 10, would think that everybody has these PMI rates that are basically the same. And you might also have people who work for these larger companies that say, hey, listen, our PMI is better because we get volume discounts from the insurance companies.
Costco discounts, baby.
Right. So what really happens behind the scene is that you've got 4 or 5 or 6, depending on the market. We've had as few as 4, and maybe I don't know, we might have 8 now because the insurance is very low claims. But you have these insurance companies that are trying to be very competitive about the way that they price their insurance product. And so then they're out there pitching and selling those to lenders so that lenders, are going to choose the company that offers the best rates for them. Now, this is very important. I said for them because they might choose a company that has a lower rate overall so that they can add a little onto it. What we've come to know in the world is that the difference between lenders and mortgage insurance rates really comes in with how much those lenders, and I'm talking about the big retail lenders and the banks, are putting on top of the base mortgage insurance premium as a revenue stream. So banks and lenders are making money off the mortgage insurance that they promote to their clients. We're still very payment sensitive and rate sensitive, and we're trying to get the very best deal. But one of the things that I didn't really understand before coming into the broker world was that the end product representative, which is the lender or the bank, is adding on to those mortgage insurance premiums to make more profit. So in the wholesale world, on the broker side, we look at these lenders and some of them may add those on and create some profit out of their own. But we've also got lenders who are always just significantly better in the mortgage insurance than everybody else in the market. which tells me that they're getting as close to the wholesale premium rate as possible. Or in effect, think about it as cutting out the middleman. The middleman, anytime there's a middleman from the producer of the product to the end user, is going to put on charges and profits on top so they can make money. In the broker world, we have the mechanisms in place to cut out the middleman and get the cheapest mortgage insurance available.
Yeah, that one blew my mind, to be honest, because it's one that, if you think about it, is so obvious because it's right there.
Yeah.
But at the same time, you just don't think about it, but it is a thing. And that's business across America. The more people you have, the bigger the company gets, the more people you have, no matter what industry you're in. If you have a lot of people, well, they're all getting paid. Okay. The only way they get paid is by you as a consumer buying the product. So that's it. You fund all of those paychecks. Now, the catch is, can the company at a large scale be doing so much volume that, like I joked, you get the Costco discount? And so that drives their costs down, which then allows them to do the scale. And it's kind of funny because people say, oh, shop local. Well, local a lot of times typically has higher prices, but they only have higher prices because they can't do things at scale.
Right.
So you either have to do things really lean or at scale. But then even at scale, you could have a lot of people that you have to pay. And sometimes the inflated workforce tips it to where all of a sudden the scaling and the volume doesn't balance out, and you still end up being more. But that's the beauty of capitalism, right? The free market is that it allows people to kind of choose their own models and dictate and do whatever they'd like to do. And that's the thing with PMI, just another revenue source that companies can tap into if they desire. So, all right, well, cool. Wrapping it up, PMI, best friend. I don't care what anyone says. Tell them to come on and argue with us, because the math, or show me a math equation or math scenario that comes out to be better for the sake of not having PMI than what I showed you earlier. I guarantee you no one can show you how to borrow $60,000 from yourself for 1.2% annual interest. It's just too good. Too good. Any last words there, Zach?
Well, I just like to put that. I wanted to say this when you were talking about this whole situation about, if you have 20% down and you decide to do 5 or 10% down and you retain that money, that's in real estate, in the purchase of real estate, that really broadens your horizons in a big, significant way, because you might find the best deal on a house that needs a new kitchen or needs a rehab of the bathrooms, or to really make the house work perfectly for your family, you need to finish out the basement. But all you've got is 20% down in your closing costs. And if you're hung up on the PMI, you go past that house when really, of all the inventory on the market in your price range, that might have been the perfect house for you. And all you really needed to do was readjust your thinking, price out the PMI and say, oh, it's going to be $50 or $60 a month in order to get this house and finish out the basement, get the kitchen upgraded so she likes it, refinish the deck, whatever it is that you need to do to make that particular house perfect. The money is readily available for really a small fee. So it's a matter of moving and shifting and adjusting and being more flexible and agile in the market as a consumer.
Well, that goes back again. Yeah. I mean, same point. Try borrowing $60,000 to do renovations.
Yeah.
On your house at 1.2%. Like, think about that.
Not going to happen.
You put 80 grand down, and then you got to go back and borrow 60 somewhere. Well, the 60 is going to cost you 14%.
If you can get it. If you can get it.
If you can get it.
Yeah.
I don't know. So anyway, folks, look, bottom line, and the reason Zach and I do this podcast, YouTube show, why we like it. One, we're passionate about what we do. Two, we're very much common sense people. Like, there's no agenda. Does it make sense or not? It's just math. Again, look at the numbers. It tells the story, tells the truth. And then things like this, like, just get out of the traditional way of thinking. I'm not saying traditional ways can't be right. I'm just saying you should be open to new ideas, because personally, there are other things I don't like. Like, I'm not a huge fan of 401ks, to be honest with you. I think there's other ways to do it that are better. Zach and I both learned about how to make your money work twice as hard for you.
Right.
We didn't know that for years. And we figured it out in the last 4 or 5. So there's so many things, like we were talking about, where you just get tribal knowledge, you get stuck, with this like tunnel vision on this is how you're supposed to do things. And in
Tribal
reality,
knowledge, that's a great phrase. Tribal knowledge. It's that knowledge that's just passed down.
yeah.
But the world is changing, man.
Right.
Grandpa,
Well, my dad told me,
yeah,
well, my dad's friend ran his business and he was successful. And so therefore, it's like you don't know the details. You know the surface level.
right.
You know the headline. You have no idea what's in all the paragraphs that support the story. So that's all we ask. Like, hey, keep your mind open, keep your eyes open, and just understand that there's more than one way to skin a cat, right? The old cliche. So,
Yep. Do
all
the
right,
math.
that's math. Math doesn't lie, man. Math doesn't lie. All right, thanks for joining us. Appreciate you guys. Make sure you like, subscribe, download, hit the bell, share, drop a comment, shoot a DM like you've been doing. Appreciate everybody. Like I said, the next one will be the quarter century mark for our episodes. I just love the PMI topic. We thought it was a good one today. Appreciate you hanging out. If you disagree or agree or like, well, I never thought of it that way, let us know that as well. Because again, he and I love looking at different points of view and alternate ways and whatever the case may be. So thanks for joining us. He's Zach Jones. I'm Chad Anderson. Have a great one. We'll see you next week.